Welcome to the Values Exchange podcast. I'm Mike Cruz, your host, private pilot, author of Saturday Every Day, and CEO of North Texas Wealth Management, a firm dedicated to values-based financial planning. This podcast uncovers the values and habits of highly successful people and dives into how it has shaped their success and what you can learn from their personal stories. All right, welcome back. I am so excited today about our guest, the Chief Market Strategist for LPL Financial. Former positions include the Chief Investment Strategist for The Hartford, Prudential Financial, Global Investment Strategist for Deutsche Bank, spent time at Credit Suisse, and U.S. diplomat background, Assistant Secretary of Commerce, U.S. Representative to the IMF, International Monetary Fund, graduated with a master's and a doctorate degree from London School of Economics, frequently in the media. So Dr. Quincy Krosby's here with us, joining us from Virginia. Hi, Quincy. How are you today?
Hi, how are you? Thanks for inviting me. When I listen to that, I think, oh my, maybe I can't keep a job, but it's all the moves that we made, my husband and the family, that, as you know, what happens when you move around the country. Things change.
Yeah, so thank you for being here. Well, I read it and I was like, well, what else is left for you to do except be on the Value Exchange podcast? So I said, we got to get you on here. But no, thank you.
Run for office. That's the only thing left.
Is that in the cards?
Sometimes when I'm speaking, especially if you hit certain targets in the conversation, some people have said, oh my gosh, is she running for office? And then I feel like, oh my goodness, do they expect me to, ask for contributions to the campaign? There's one topic today that which one it is. It's a political one that if you press that button, you'll know what I mean and what your clients mean.
All right. Well, I can ask the right questions to get you to run.
Yeah.
So.
Yeah. Yeah.
Well, so I kind of want to just start with big picture and we look at it. So I always talk about values, and we talking about the value of understanding the intersection between markets and the global economy. So no small topic by any means. And, I wanted to kind of just take a step back and look at financially, what are the signals that you're looking at that would help us define where are we right now? How did we get here? And then, maybe we can pivot into kind of where we're headed. So how do you kind of define our current economy?
It's so interesting because, having worked on Wall Street, starting on the trading floor environment, you realize that the economy is not the same as the market. Most of us think it's the same. It isn't. Sometimes it overlaps, but we always say about the market that the market looks ahead. The market sees things that the economy, the economic data, do not see or does not see, because data, by the way, happens to be plural, but everybody thinks it's wrong. But nonetheless, that's the interesting thing. So the market could be looking ahead and saying, wait, we see green shoots. We see the economy doing well, pulling out of a downturn. And yet you could be mired in very weak economic data, even a recession, and you did, well, the market must be wrong. Normally, the market actually is correct. It moves ahead by 3 to 4 months looking ahead. So what got us here is we lived in a period of zero interest rates. Sometimes they were even negative if we factor in inflation. Rates were extremely low, and that's underpins a go anywhere market. I mean, it pushes the housing market because rates are so low, equity markets. And we had that free money from the government during COVID. Both the Democrats and the Republicans put these transfer payments into our accounts. And again, you couple that with rates that just were nothing, you get a market that enjoys taking on risk. We always would say that risk begets risk until it doesn't. And then we went through a period in which the supply chain challenges were really dramatic. I just use my own experience, waiting for a refrigerator for months. Not fancy, made in America, supposedly, but so many of the parts came from China. And when I finally did get it, it was much more expensive than anything I had ever dreamt about, but I needed it. But that happened to so many of us. And we wound up in a situation in which inflation started to climb higher as prices climbed higher. And then to get workers, particularly as COVID eased, and this is global, by the way, it was very difficult to get workers. You had to pay a lot more. And when you pay workers much more than you expected, it is an input cost, just the way chemicals are an input cost for a manufacturing company. You try to pass along those higher costs to the end buyer, consumers or businesses, and that also pushes up inflation. However, the Federal Reserve looked at these higher prices and thought, okay, it's temporary. It's temporary. The supply chain challenges will ease, prices will come down, and the inflation that we saw would be transitory. That was their word for temporary. And I remember we talked about this, Mike. I looked it up in the dictionary. I thought, maybe I'm wrong. Maybe I don't know what the definition is. But it is not a long period of time. The Fed made a mistake in calculating the effect of this inflation on the economy and the length of the timing of inflation. So when they did get started, which was a year ago in March, albeit not very aggressively, the market suddenly went from easy money to now tightening. We went from loose conditions to going cold turkey. That was difficult for the market, for the bond market, difficult for businesses to try to figure out what the Fed was going to do. Now, keep in mind also, the Fed went from 0.25% to 0.5%, right? We could live with that, to suddenly going to nearly 1%. And that was 0.75%. That move was aggressive. This has been one of the most aggressive rate hike campaigns in modern history. And what it did was it jolted all of us. It jolted all of us because the Fed's goal was to dampen inflation by dampening consumer demand. We, the consumer in our country, we're 70% of the economy. And it all stems from a healthy, resilient labor market. So where we are now is the Fed meets this week. The market is hoping that this is what they call a one and done, that the Fed finishes. The Fed says it's pausing, but basically is telling the market they're done. This is what the market is hoping for. And the market is actually, there's something called a futures market, is looking at rate cuts beginning in November. Now, the futures market is not necessarily correct, but very often it kind of nails it because it's an ongoing, it's fluid. It brings in all of the information it has, and it tends to make a decision. So that decision right now is that tomorrow, when the 3rd of May, we do get a 0.25% rate hike. The question for the market is not that. It's how does the Federal Reserve package it? Do they make it that this is it? This is it. Or do they signal somehow that the Fed is still watching inflation? We don't know. Perhaps they don't know. But one of the things that they're looking at is a still strong labor market. And when we look at manufacturing in this country, which, by the way, is much smaller as a component to our economy than it was, say, in the 1960s, it's only about 8% now, but it's still important. But what we're seeing is that the prices that are paid in the manufacturing sector in our country, those prices are going up, not down. And still, manufacturing is mired in a downturn. So it's kind of stagnant at this point. but yet the prices are climbing higher. That is not what the Federal Reserve wants to see.
Right. So for the average investor, when they hear you say that, there's so many things, and just kind of talking about where we are currently, there's so many things that I think investors are concerned about. And so, we've had the regional banks. We talk about, inflation and whether or not that's being curbed or not. Kind of depends on the data that you look at. Some of the housing data suggests otherwise, but we know that data tends to lag. And then we start going from, concerned about the banks. I want to see if you could address that. And maybe we can also talk about, what we don't want to talk about, which is the debt ceiling. But
oh, that's the one. Press the button.
Right,
you'll have to say goodbye early. Yes. Well, absolutely. I mean, because if you look at the market right now, as we're doing this call, home builders are doing very well. Why would that be? Well, part of it is that we're still seeing people buying houses. Mortgage rates may be up, but the home builders are trying to to work with potential buyers. And at some point, obviously, they know that the Fed rate hike cycle is going to end. If it isn't tomorrow, it could be perhaps even in June. So that's the market looking ahead. But the other part of the story is the banks. Yesterday, we had good news. That was Monday, May 1st, early in the morning, that JP Morgan was going to take over or buy the most of the assets. In essence, First Republic, which would represent the second largest collapse in banking, modern banking history, after Washington Mutual, which was the largest. This would be the second largest, First Republic. But the market's view seems to be, at this point, that has been contained now, that now it's been contained, that we don't really have to worry about any systemic risk spreading into the banking system. The other part of the analysis of what happened with Silicon Valley Bank and what happened with First Republic Bank is that very poor risk management, in fact, no risk management, and also that we had a failure from the regulatory system, and that would have come out of the Federal Reserve Bank of San Francisco. They have regulators, they are supposed to monitor the banks in their region, in the territory. And the job they did was obviously not good enough at all. Chairman of the Federal Reserve, Powell, made a comment at the press conference following the last Federal Reserve meeting in March. And he said, regarding Silicon Valley Bank, he said there were lots of red flags, but we don't know where they went. They didn't come to Washington. And you're listening to this and you're saying, what? What did you just say? There was a failure, a complete failure. The supervisors responsible for examining these banks just did not do their job. And you couple that with the bank's own lack of responsibility, lack of risk control, you see what happens. So we're glad that JP Morgan Chase took over that, because JP Morgan has an excellent reputation. They will do well with this. The only concern right now in the banking system, it seems to have, how shall I say, been contained, hopefully. However, the market is worried about real estate, commercial real estate, where across the country, small and mid-sized banks really are the bankers for much of the commercial real estate market. And the question there is, what is happening, particularly in the larger cities where the buildings are not occupied? Folks are not coming back to work 5 days a week. So there's quite a bit of space available. Not everything can be converted into a condo building. The concern is, because we're already seeing it, late payments from some of the very well-known property developers. What happens down the road? On a positive note regarding this is that many of the analysts believe that this will not be a climactic hit to the banks as the loans are in delinquency, that it will be in stages so that it won't cause anything dramatic to happen, such as what happened with First Republic Bank and Silicon Valley Bank. But it's definitely in the offing, it's definitely in the cards, particularly if interest rates go up even more than where we expect this week.
So, no, that's great. So, and then, the debt ceiling. So average investors looking at the news, we're talking about the banks, we're worried about the economy. And then now the debt ceiling comes into focus. What happens? Can you kind of play that out if the, politics take over and, we have a default? What does that mean for investors?
It's not good. It's not good. It is not good. Simply, it's not good. And the concern here is that for both parties, the extremes in both parties this is just a concern. I don't want to say it's going to happen, but it's a concern that they are so adamant and so frozen in their positions that they would be willing to allow the debt ceiling to just go over the cliff and allow the ramifications that would ensue. That's the concern. The concern is that the middle of both parties will not be able to keep these extremes at bay. Needless to say, there is no doubt that there needs to be budget cuts. The budget is overwhelming. The budget has been band-aided, if you will. It's had a band-aid fix all these years. We don't have enough people coming into the workforce to pay some of these expenses throughout the system. So things must be done, but it's very difficult for politicians to do it because it's unpopular. It's extremely unpopular, but it has to be done. And, we all know, I don't have to name the outlays that the average American works for and pays towards. But there is so much fat within the overall budget that it really has. If we don't do it now, what we're passing along to future generations is an era of taxes that will have to be paid to take care of it. That's not fair. It's not right. And it creates an economy that is ballooned and that just simply can't function.
Right. And, especially with interest rates increasing, doesn't that just make that problem worse? And so do you see their actions ultimately might be taken to lower interest rates just because we can't afford to not make that happen?
Mike, it's very interesting that you say that, because when the Federal Reserve buys bonds, treasury bonds, it lowers the interest rates, does it not? That's the whole point of it.
Right.
Many people believe that it was in 2009 when this quantitative easing started, this tool that the Federal Reserve has and used at that time to bring down rates to try to stimulate the economy. However, actually, the Federal Reserve bought bonds toward the end of World War II, and it lasted for a number of years. Why? To do what you just said, to lower the cost of what it cost in the war to pay it back. That's exactly what they did. And so that is an issue as the rates go up. I will tell you that, again, part of this battle is that there are extremes in one of the parties, I don't want to get political, that believes that's exactly what the Federal Reserve should do. Go in and keep buying bonds and perpetuate it so that you can have anything you want in the budget. Anything, just whatever it is, you put it in there, have it done, and just have the Fed keep going in and buying bonds and buying bonds. That's a theory, and sometimes you wonder if that's exactly what's happening. I don't think so, but we're moving in that direction because of this inability to sit down and do what we need for our country. The two parties, I believe, at the core of both parties, want to get it done. They know they need it. But here's the other political gist of it, is it appears, just from my reading of it and talking to people whom I have worked with in the past in the government, that each side believes these are the fringes who are recalcitrant, believe that they won't be blamed, that the other side will be blamed, and it'll become a political plus during an election period. When you talk like that or even think like that, you're hurting all of us. You're hurting the American people who put you in the office to look after us, to look after people who have worked all their lives to retire with dignity, and just say, well, you're just a pawn in a bigger game, a bigger political tug of war. That's wrong. It's not right.
Exactly. I agree that you shouldn't even, the talk of the debt ceiling, we've raised the debt over 100 times. That shouldn't be a political pawn, right? So right. Looking at, what's going on domestically, but we're raising rates. I mean, we're not the only ones, right? This is happening globally. So can you talk about kind of the global exposure in portfolios? Is that important? Is that something that safeguards? How do you see that kind of playing out?
Well, it's always very helpful. Many people do it many different ways. We have so many companies in the United States, the big multinationals, the big tech names, for example, that have a global footprint. Many people go that way. Starbucks, I'll give you one example. Starbucks is reporting this week. They have a major footprint in China. So that's another way people actually invest. Also, China is major. It's the world's second largest economy. It has just come out of almost 2.5 years of being locked down because of very strict COVID requirements. This is the rebuilding, if you will, of China. Well, it's interesting because as they opened the economy, it's initially being predicated on consumer spending. And ironically, it's no different than Americans coming out of COVID, Europeans. But here's the interesting thing. The Chinese have been traveling primarily domestically. Some have been going overseas, but in the cities in China, they are luxury goods stores, famous names out of Paris. Well, LVMH, which is Louis Vuitton, came out with their earnings. It's Paris-based, came out with their earnings just a couple of weeks ago, and it's the best they've had. And they said, thanks to the Chinese consumer buying our goods. And they said the U.S. consumer buying less, but more than made up for by the Chinese consumer. So my point here is the global economy exists. There are many ways to access it. Emerging markets are extremely popular in portfolios. However, we believe in active management because what active management does in emerging markets is they understand the local economies. They know what is working. They know the economies where you see the beginning of a middle class, where the companies are focused domestically. But the other part is emerging markets, for example, they need to have a weaker US dollar. And as the dollar weakens, because as you point out, we're finishing up a rate hike campaign, but that will weaken the dollar, will continue to weaken and soften the dollar. It's good for our multinationals, but it's very good for global financial conditions. For emerging markets, it's excellent. They import quite a bit of oil priced in US dollars. It becomes less expensive. They have dollar-denominated sovereign debt, dollar-denominated commercial debt. Then it's easier to service that debt. And the other part of the story is that because financial conditions ease quite a bit with a weaker dollar, it makes global trade more attractive. So I'm not suggesting that we go into emerging markets now, but I wanted to explain why emerging markets tend to do worse when the dollar is very strong. But we're in a period right now where the dollar is easing, and easing actually quite markedly. So when the Fed is finished, you'll see Europe probably still has some more rate hikes to go. The Bank of England, we know, is prepared to raise rates more to quell inflation.
So if you were going to create a scoreboard for the current economy, we have 100 factors we look at. If you were going to limit that down to like a dashboard of like 5 key, metrics, what are you watching? What's really important right now?
Labor, the labor market. And the reason for that is when we look at the path to a recession, a normal recession, right? Not where we're hit with a pandemic or some shock to the system. But typically it begins when we listen to companies, which we're doing now. We're in the earnings season, and the guidance is very important. And what we listen for is they're about their margins. How much do they have left after paying all the costs associated with running a business? What's left? We call it their margins, their operating margins. The reason I mention this is the more revenue growth slows, meaning how much comes in, the more they're paying in terms of wages or any other input costs, the more pressure on those margins to come up with an attractive bottom line. What do? They will cost cut, and that includes layoffs. So the more layoffs that we have, obviously that starts building the unemployment rate. When that happens, then we see consumer spending, which is 70% of our economy, slows down. You do that long enough, for a month or two, you're in a recession. And so we look at what companies are saying, but then we translate it into how strong is the labor market. As long as people have jobs, people are going to spend. And the labor market has been extremely strong and resilient. So this Friday, we're going to have the payroll report. And what are we looking for? Wages. Have wages gone up too much? Because we know that the Federal Reserve, particularly the chairman, Jerome Powell, is focused on that. Because remember, just as we said, the more that wages go up, the more companies are going to have to pass along those higher wages to the consumer, to businesses that buy the products. That's inflationary. So we'll look for that. We're also going to be paying very close attention, and the overall scheme is, what do individuals, average Americans, see in terms of inflation? The reason this is important is that the Federal Reserve does not want to see Americans seeing inflation rise too much over the course of a year or 3 years. Because if that happens, what they're worried about is that it becomes entrenched. And when something becomes entrenched, it starts to be difficult to unwind it. And I'm sorry to say that Americans looking ahead over 1 year are seeing inflation rise to about 3%. The Fed doesn't want to see that. So the other thing we look at because of this, we know that when gasoline prices climb higher, and every day You pass, how many filling stations does somebody pass in one day? A lot. And believe it or not, when the prices keep going up, even a little bit, very soon afterwards, inflationary expectations rise. When gasoline prices come down, inflationary expectations come down. So that's important as well.
Very good. Now, when we look at the Fed, coming out of the pandemic, there's kind of this mentality of whatever it takes to kind of get the economy back going again. How much of that mindset's now carrying over to inflation? And if we look at it, they really only have two mandates, which is full employment and then, to curb inflation. So are you concerned that, instead of in June when rates potentially are, peaking, that they might look at this and say, hey, the labor market's fine, let's just keep pushing. We're only focused on inflation until maybe they push it too far? Where's that tipping point?
Well, that's the concern really right now. I mean, and there's an open debate actually at the Fed. Many of the presidents of federal banks around the country are talking about it. Why this obsession about wages? Why this obsession about labor so much? Aren't you afraid to keep tightening and then just push us directly into a recession? The reason it's important for the Fed is they go back in history. Chairman Powell has mentioned it many times. They don't want to repeat the mistakes of the 1970s. Back then, the head of the Federal Reserve raised rates, stopped, raised rates again, stopped, and allowed stagflation to take hold. Stagflation is pernicious. It is when you have no growth, but you have high inflation. Paul Volcker inherited that. And for those who remember, he pushed the rates up. Rates went up to 20% in order to kill inflation. He put the economy into a recession. The man was despised. He hurt the unions because he basically made it so difficult for them to get raises that there were concerns about throughout the country whether or not he was going to be safe. You talk about the housing market. I'll give you a little anecdote. My husband and I bought a house back in the early 1980s, and I think the rate was maybe 14%, the mortgage rate. People thought how lucky we were because it was so low. Try to imagine that now. And so Powell is worried that because there are, how do I say this, scintilla, a slight film of stagflation in the inflation backdrop, he doesn't want that to spread. And I think he doesn't want to give up tightening because I believe it or not, because in many ways he has the luxury of a still strong labor market. And he knows that a recession hits when the labor market is really weak and is continuing weak. That's why this report is going to be important. We want to see on Friday how many jobs were created. Right now, it's still healthy. But if we start seeing that number come down in new jobs, not being created, but they're lower and lower and lower, that we're headed towards a major slowdown, if not a recession.
And, kind of to go back to markets and the economy are quite different. And I think, the question back in an investor's mind is how much has the market already priced in the probability of maybe a slight recession? And potentially we could be going into a recession at the same time the market could be starting another bull market, right? Anticipating maybe future market, interest rate declines. What do you kind of see there?
That's what makes the market, as we like to say, right? That's why the futures market, this is really interesting, what we call the Fed funds futures market, is looking at a rate cut coming in November. when we started to see the consumer price index come down, that showing inflation was finally starting to pull back. This was back in the fall. The rally that we enjoyed was a rally looking ahead with a cyclical orientation. In other words, we didn't see consumer staples in that rally. Just all about growth, all about the future. And that has been the hallmark of virtually all of the rallies, that the market, because most of the rallies, by the way, have been based on inflation coming down, and that the Fed soon finishing the job. However, the recent rallies that we've had have now started to include the defensive side of the equation: consumer staples, utilities, pharmaceuticals. That's not what you want to see if you are hoping that we are pulling out of this. Now, for the most part, the rallies are still heavily skewed towards cyclical, meaning getting out of a downturn. I always look at my bellwether happens to be the semiconductor names, because they are in everything. The semiconductors are the chips. And many of the analysts have likened them to transports, the way the transportation sector gives us a hint of the future. The more the transports do well, the trucks, the trains, it tells us that goods are being moved across the country. Well, the semiconductors are a picture of global demand. And because everything includes a chip, I actually received a toothbrush that had a chip in it. It talked to me. It was kind of scary, but it talked to me. And it's in every missile system. It's in every vehicle, especially electric vehicles. It's in artificial intelligence. It's underpinning. It's the infrastructure for artificial intelligence. But the point I want to make is that's what we want to see leading. And it's been leading because, again, it gives us a picture of global demand. So you asked me, what is the equity market telling us? It hasn't figured it out yet. As long as I keep seeing utilities in there, as long as I see consumer staples in there, and I see the drug companies in there, it's telling me that investors are not quite sure, that the market is not quite sure. I do believe that by next week, after we get through another round of earnings, including Apple, by the way, the big Apple, we'll hear what they have to say because they've got their finger on the global pulse of demand. But we'll have the Federal Reserve, and we will have an all-important payroll report on Friday. We will have the market, I think, making a more definitive decision on which part of the market is winning.
Yeah, so Quincy, for the investor looking at, what does that mean for my portfolio and the market, and kind of just really understanding why, what we try to remind our investors is that, there's a lot of different factors. We're looking at not only, economics, that's a key component. We're looking at volatility, but then we go back to key measures of valuations and growth. What is, I guess, LPL's approach to what do we see where the market's headed, taking into account that there's economic challenges, but that's just one factor?
Well, absolutely. I mean, one of the things that has surprised us, and we've just written about it, is the resiliency of corporate America. Coming into this earnings season, folks, we always look back, obviously, but we look for the guidance of what companies are telling us. And we've had a host of positive surprises, and in different sectors, not just in big tech, which has come out and surprised us with positive guidance and solid numbers. But we've had it in what we call consumer discretionary and consumer staples. So we've looked at, Chipotle, for example. We looked at McDonald's, all of our favorites, PepsiCo, Coca-Cola, all telling us we had to raise prices, yes, but consumers are paying for it. Procter and Gamble, I haven't gone off brand yet, but they came out and said, Quincy, thank you very much. You've been buying that Tide free. I'm not alone in that. They've raised their prices, but we're still there. But the point here is across the board, yes, we've had some companies telling us that they're worried, but overall, the reporting has been stronger than expectations. Now, do we think we are headed into a recession? We think we could have a mild recession, but that's part of the economy's righting itself. It's part of the market righting itself, coming into, as you mentioned, valuations. What valuations are? They're a picture of all of the headwinds that a market has to face, but also all of the tailwinds, and bringing it in, digesting all of it, and coming up with a number that represents, that's in concert with what companies are going to have to face, the good and the bad. So this is all important, and we're in that transition period right now. And this is why the market is trying to figure out, should we just abandon the defensive side of the equation and just go all cyclical, or should we have a mix? Well, the way we look at it is have good companies, have companies with strong balance sheets, companies that can get through any environment, but companies that have a good share of what they sell. In other words, as they like to say, a moat around them. They enjoy they enjoy their primacy, if you will, in their space, in their particular space. Those are the companies what we're looking at right now. These are the companies we want. And let's also remember that the fixed income market has become an important part of the portfolio now, something we haven't had in years as rates have gone up. The fixed income market, the treasury market, corporate bonds have become an important component of our portfolios. We're so grateful for that because now there's another choice. We can balance the portfolio with fixed income.
Yeah, that's right. That's been a challenge, especially last year where you had equities and, the fixed income market declining. It's probably one of the most challenging year for investors, whereas finally we have some lower risk return options.
Yeah.
So that's absolutely a great component. So the first time I met you, you were the keynote speaker when you were working with the Hartford, and I had the opportunity to hear you speak, and that's been great. But you've always had so much passion for this, and I just kind of wanted to take a second to, how'd you start on this journey? Where did that passion really start for you?
Well, it's interesting. It came from, I started on the other side of the business. I started working in trading floor environment, and then worked in derivatives. And I only knew what we call the institutional part of the business. That's the pension funds, for example. It's the bigger position. In that part of the business, we don't see Main Street. We know that ultimately the products and the investments are for Main Street. But I'll tell you what happened. On 9/11, I was working in New York, and I had come over from the sell side just a few months before 9/11 to work with a portfolio. It was institutional, but they held money. They managed money for pension funds. And when 9/11 hit, the managers didn't go home. The managers of the group I worked in, they stayed, and they would not go home. And the reason was very simple. They said, we have an obligation, Quincy. We have an obligation to the folks whose money we're managing for their futures. This is pension money. We need to stay. We don't know when the markets are going to open. We have no idea when the markets are going to open. We don't know how much selling we're going to see. from European insurance companies, for example, which actually were holding more equities. In the US, the insurance companies were mainly in fixed income treasuries and so on. And they said, we need to be prepared to buy what we always wanted to buy for the portfolios, but be able to sell what we want to sell. This is an opportunity that we can't pass. And because of the unknown of when markets were going to open, we've got to stay here and prepare for it. We owe it to our holders, the people in these pensions. We didn't know who they were because you're managing a huge pool of money, but we knew who it was for. We're talking about firemen, policemen, teachers, religious orders, and not just in the United States. And when I heard, as I'm talking about this, it's reminding me of waking up to the fact that this was not just a big amount of money. This was about people. It was about people's futures. And it's when it hit me that it's Main Street when we bring it back home. It's High Street when we're talking about our clients in the UK. And I could go on and on. And that's when I moved to the Hartford, when I saw you, it was for geographic reasons. I lived very far away from Wall Street, and it was closer for me to get to the Hartford. But my job would be about the funds, the money that was for Main Street. And that appealed to me. And ironically, the reason I was at Prudential for so many years is that Prudential bought a good portion of the Hartford, and I went with that group. But it never dawned on me when I first started on Wall Street. Isn't that amazing? You're trading billions of dollars, billions. You are working in derivatives. That doesn't sound like it belongs to anybody. And you're building funds that are based on illiquid stocks underpinned by derivatives. It doesn't sound like that belongs to any one person.
Yeah, it seems
but
like
when it hit me, it really hit me.
Yeah, it seems like you're passionate about that. It made a difference. What do you hope? Like, if you could hope that you kind of leave behind, what difference do you hope that you make?
Well, I just hope that we have people in the industry who recognize their responsibilities, because, when people hear about financial advisors, they just think, oh, you just move money around. But what I know is that every financial advisor whom I'm close to, which happens to be a lot all of these years, you represent far more than just someone's portfolio. You are there as a social worker, a minister, a guidance counselor, marriage counselor, everything. And you work round the clock at this. And I hope upon hope that the future, given artificial intelligence and being able to, just be online and take care of your portfolios, that folks understand that there are times when you need a person behind it. You need to work with a person, and that I just hope that the industry attracts the kind of people who understand the importance of what they're doing. This may sound odd, but one year I actually worked with, many, many years ago, before I didn't have a college degree, but for a variety of reasons, I worked with the disabled children, teenagers. And it was in a day center. And I remember that the parents' biggest worry was what was going to happen when they were gone, and the importance of portfolios for them. That hasn't gone away. And so the industry needs people, not just with the acumen, financial acumen, to build portfolios, resilient portfolios, but also with the empathy that goes with it and what people's individual scenarios require.
Absolutely. And I think You said it earlier, but it's about living with dignity, right? And those times where, you lose a spouse or a child or, something in life happens, you lose your job. It's how do you go live a life with dignity? And an advisor plays probably the most critical role at that time, but you have to have trust, and you can't build trust overnight. So if you have an advisor, sooner the better. And then I think you're right, it's empathy and then that communication channel to really understand it. So sometimes we talk all about economics, and that's important, but it is just a piece of kind of that bigger picture, and having somebody that you trust to guide you through those times. And then definitely in retirement, so you can retire and live that life of dignity and not have to either work forever, or if you're not able to work, not have enough to make it. And have to depend upon others to support you. So I agree with you. It's I'm passionate about it. It's a critical role for society. Yeah.
And I know that you understand this and you live it with your clients. And that's my hope, is that the industry has folks like you that understand it is more than just portfolios, because then I could use AI, I could use artificial intelligence, right? I could just plug in the numbers, but pretty soon we'll be able to do it. But it's much more than that, particularly what you've gone through the last 2 years with the markets.
Human connection and empathy is hard to manufacture, even if AI can do the rest of it, right?
Yeah. Exactly. Yeah.
Well, thank you so much. Thanks for shining a light on this and kind of helping us connect the difference between markets and the economy and your passion. I really appreciate your time.
And thank you so much for inviting us. We appreciate it. And all the best for a strong finish to the year. Thank you, Mike. I appreciate it.
All right. Thanks for tuning in for this episode of the Values Exchange podcast.